Derek, one of the gauges that we use, sort of a measure of market sentiment, I want to talk about this because it set a new low. It's something we call the Fear and Greed Index, and we watch how it swings from the highs to the lows, and it really helps inform some of our investment decisions. So 24 new low so far for the year.
Yeah, what I like about it is it reflects what investors are actually doing, not what they're saying on television or what they're touting from time to time. And basically what it is, it's an indicator that is composed of 7 subsegments, some of which address market movements, others of which address sentiment, credit spreads, the volatility index, and the like. And as you mentioned, at 24, that's the lowest it's been this year. You might recall we talked about this a lot of times during the heat of the financial crisis in 2020 during the pandemic when it got as low as 2. And that was just a suggestion that, there's a lot of fear out there. It's a time not to be panicking, throwing stocks out the window, actually doing exactly the opposite, looking for opportunities where they present themselves. And while 24 isn't as low as 2, it certainly suggests that this recent pullback we've seen in the markets has been masked by the strength of the S&P 500.
So you're saying to some extent we treat it as sort of a contrarian indicator when we think about things like rebalancing.
That's exactly right.
So I think it's a good way to approach, portfolio management. We talk a lot about what's going on in the economy, help inform investment decisions, but ultimately, one of the activities, of course, is keeping your balance in your portfolio, understanding levels of risk, knowing when to do those kinds of things, and using some of these kinds of tools to us far better approach than just flipping the page on the calendar and saying, well, it's the new year, so it's a new rebalance.
Right. And the Fear and Greed Index, in a way, is part and parcel that. It's a reflection of what the market is doing currently, and when it gets to a very low level, it suggests now might be a very good time to rebalance the portfolio, add to areas of the portfolio that have been weaker that you still like for any number of reasons, and reduce those that have perhaps held up better that are now more expensive.
A good indication of that, for example, if you take a look at movement in sectors within the market. Last year, the most unloved sector was energy. This year, it's the top performing sector so far for the year.
Right. It was hated last year, loved this year. A lot of people got caught underinvested there. Certainly, oil prices have gone up significantly as the economies around the world begin to reopen. And so that's been a plus for those that were tactically allocated in that area. The other thing is, just this week, the S&P 500 had been up 3 weeks in a row. It was down 1% for the week. Not a lot. But the small caps really took it on the chin. They were down about 5%, and that ARK fund family, as I mentioned in the past, where they own very highly speculative, long-dated growth opportunities, that fund was down even more than that. So there was a lot of selling that was masked by the strength of the FAANG stocks.
Yeah, masked is a good term, and we've seen this prior, in the market. So even so far this year, beginning of the year, I would say we saw what was close to a correction in tech stocks, but really, at that time sort of masked as well, because that was a spot where other sectors, such as energy, were really starting to rally. So you might see these opportunities that happen really, in my opinion, sort of under the surface.
Right. Since May 12th, just 8 stocks have accounted for half the S&P 500 advance. The names like Amazon and Apple, Nvidia, Netflix, Microsoft, and Facebook have all done very well as really that reflation trade started to go the other way. I think commodity prices had reached a peak. So there was a lot of interest in basic materials and financials, thinking the yield curve was going to steepen. But we've seen a rotation back as growth hopes for the second half into next year waning a little bit because of the problems we're having with the Delta virus, and also just the thought that inflation and stimulus are coming, but they're going to be offset by higher taxes down the road.
Yeah, we're smack in the middle of earnings season, by the way, and so this past week, Taiwan Semiconductor came out with their earnings, strong quarter for them. But probably the most important thing that we should talk a little bit about was they, gave some indication that they believe that the chip shortage was going to resolve itself by the end of the third quarter.
And that's very important. Taiwan Semi is a leader in technology. They've definitely lapped Intel in terms of technological innovation. And by saying something like that, that suggests that the auto companies, which have had problems getting sources for chips, are going to be able to do so. And that's one of the reasons why auto sales have actually been somewhat sluggish, because there simply are not enough chips to go around. Another reason why rental car prices have gone up so much as well, because new vehicles are unavailable.
Yeah, so it'll be interesting to see if that plays itself out the way that they indicated it would. And, one of those things that might alleviate a bottleneck that has been, leading to some of that sort of reopening sluggishness.